Everyone's predicting rate cuts from the Fed this year. However, we have higher inflation numbers than expected. How's that going to impact the interest rates here in the Huntsville market and really across the US? We'll jump into that, but before we jump into that, make sure you hit subscribe below to stay on top of all the latest Huntsville, Alabama real estate news. So let's jump right into that CPI data. CPI data for January came in at 3.1%, which is a huge improvement. It's a 3-point drop, over a 3-point drop from last year. Last year we started at 6.4%, ended the year in December at 3.4%, so we're still headed in the right direction going down. And it's also a huge improvement from the peak of over 9% inflation. However, life is all about expectations and predictions, and unfortunately the street's expectations were 2.9%, so we came in much hotter in terms of inflation than what the street expected, and that has caused the stock market to drop 525 points the day that data came out, and that's also increased the 10-year treasury yield as well, which is pushing 30-year rates up just slightly due to this higher inflation data that's come in. So what creates interest rate volatility is the difference between what the Fed does, what they signal, and the overall market expectations. The Fed has signaled that they're going to have 3 rate cuts in 2024, which is different than what the market's been expecting. We're a little bit closer in terms of what the Fed's signaling and what the market's expecting now. The derivative market was pricing in 4 to 5. They're ultimately probably pricing in less than that, maybe 3 or 4 at this point, with the CPI data coming in at 3.1%, realizing that they were probably overly enthusiastic, especially when you consider last year the future traders were betting on 7 rate cuts in 2024. So obviously that does not appear to be what's going to happen in 2024. And so when you have 7 and you have the actuality of probably 3, that's what creates that volatility in the marketplace. Now that those two are converging, I expect to see less volatility in the overall market, and I expect to see the Fed actually cutting rates here in 2024. The Fed's ultimate decision, however, will be based on whether inflation continues to come down and also the job numbers as well. Probably not coming down at the next March meeting because jobs were higher at 353,000 jobs added in January, which was much higher than expected. And of course, what we already talked about, this inflation coming in higher than anticipated. They expected 2.9%. We're at 3.1% right now. Just as a side note, the Fed is wanting to get that magical 2% number. It's going to be a really difficult number to achieve, just with all of the government programs and everything that is coming down the pike in terms of additional money printing. It's going to be a tall order for the Fed to get down to that 2% rate from where we're at 3%. They're trying not to undershoot the inflation as well. If they undershoot it, lowering rates, that could push up the inflationary numbers on housing, which could get us above 3%, get us in that 4, 5, even 6+% range. And so they're trying not to do that, but they're also risking overshooting by waiting too long. So that's kind of the predicament that the Fed is in right now. They don't want to undershoot and they don't want to overshoot. So when are all these Fed rate cuts potentially going to happen? Well, the next scheduled meeting is March 20th, and most experts are not predicting rate cuts for that March 20th date, and that was because of the high job numbers that came in. Now with this higher CPI data, 3.1 versus a 2.9, very unlikely to see any rate cuts in March. A lot of experts were predicting that next meeting, that's May 1st meeting, would be the first potential rate cut by the Fed. That may actually even get shifted off. June 12th, I think, is a realistic possibility. August 31st is a possibility as well. However, I think that's going to be probably later, just because we're in an election cycle. I just see too much pressure coming down from politicians in Washington to get rates in the economy and a good footing for re-election. So August 31st is probably going to be too late. That might even be the second rate cut. The other meetings are September 18th, November 7th, and then December 18th. So again, the Fed is signaling that there's going to be 3 rate cuts during 2024. And I think that's a pretty sound prediction, even with the CPI data coming in a little bit higher, just because we're in that election year. If we weren't in election year, I would say it's possible that we wouldn't have any rate cuts this year. So Realtor.com recently ran an article about the worst possibly being over for the housing market. They actually interviewed us for that as well, Huntsville being a highlight for the rest of the nation, so they came to us to get that information. One of the recommendations I would have, if I'm thinking about selling my home right now, is that, I would want to have my home on the market prior to that first rate cut, because when the rates start to come down, that's where a lot of additional buyers are going to come into the marketplace, and I would want to have my home on the market to be shown and possibly get bid up during that time. The second thing is, if you're a buyer, I'm actually thinking I may want to go under contract prior to the first rate cut. Even though that might give me a little bit higher interest rate, I think that's going to give you much more negotiation room, potentially get a better price, better terms, and you can always look to refinance after these 3 rate cuts. So that's how I would try to take advantage of both things. I would try to get the best price today, get the best interest rate as rates potentially come down.